Today's lesson is on qualified plans. Are you saving taxes? My name is Monica Felton, and I'm a certified financial planner. I educate families on how to get very efficient with all of their money. What is a qualified plan? A qualified plan is a government savings vehicle that, based on rules and regulations, qualifies money for tax incentives. Examples of qualified plans are 401k, an IRA, a 403b, or a thrift savings plan, or TSP, to name a few. So what do qualified plans really do? Well, they actually do two things. The first thing they do is defer the tax. I like to use the word postpone the tax. And the second thing they do is postpone the tax calculation. Now let me remind you, money put into a qualified plan is pre-taxed, which means you have not paid any taxes on this income. In a qualified plan, taxes are paid when you withdraw the money. You are eligible for withdrawal at age 59 and a half to avoid any penalties, and it's 59 and a half or older. So, if the tax calculation on my qualified plan money is taken at withdrawal, I have to ask myself two questions. The first one is, what tax bracket will I be in retirement? Now, I'll tell you, most of my clients feel they're going to be in a lower tax bracket in retirement. But my question is, how is it possible? Today, in 2015, the country is $18 trillion in debt. I didn't say million. I didn't say billion. I said $18 trillion in debt. We have 10,000 baby boomers retiring every day for the next 15 years. And they will all be eligible for government programs like Social Security and Medicare. And unfortunately, our country will continue to have natural disasters, will be faced with wars, and now terrorism. So how is our government, the U.S. government, going to pay for all this? Well, the answer is taxes. And who do they tax? They tax the people with the money. So I ask you again, what tax bracket will you be in retirement? The next question is, what deductions will you have when you take the money, when you withdraw the money out of your qualified plan? Now, likely, if you've followed traditional financial planning, you're going to have your house paid off. Your kids will be moved on and hopefully happy and starting their own families, and therefore you will have no deductions. You will become the perfect taxpayer. So let me give you an example using the qualified plan tax calculation. So let's say that I begin contributing into my qualified plan, like a 401k, $18,000 a year. I'm going to do that for the next 20 years. Now, my tax bracket during my earning years is about 30%. I'm also making the assumption that my withdrawal tax bracket will be 30%, and I can earn an investment rate of return on this investment vehicle, this qualified plan, of 5%. So at the end of 20 years, I will have a qualified plan account balance of almost $625,000. That's marvelous. Here's the challenge. Not all that money is yours. Remember, you have a partner in a qualified plan, and that's the U.S. government. You've never paid taxes on any of this money, and now it's time to pay the piper. So in actuality, your share of this balance is about $437,000. The government share is $187,000. That $187,000 represents 30% of this overall balance of $625,000. Now let me remind you, you have postponed paying taxes over 20 years to the tune of $108,000. So you postponed paying $108,000 only to turn around and pay the government $187,000. That's $80,000 more in taxes. Now, why is that? The answer is that the government's savings plan is the same as yours. So they don't care what rate of return is in the account. They just want the percentage of the balance. Let me show you what I mean. Let's say we had a marvelous 20 years and actually earned an average rate of return of 10%. That means in 20 years, my balance would actually be almost $1.1 million. Now, the government will still want their share of that balance. They'll want 30% of it. 30% of $1.1 million is $340,000. Now, let me remind you, you postponed paying taxes of $108,000 so that you could turn around and give the government $340,000. Now, let's say your investment return was dismal, that over 20 years you only earned 2%. Your account balance would drop. You see now it's at $446,000. Your share is $312,000. The government's is $133,000. Again, I remind you, you postponed paying $108,000 so you could turn around and give the government $133,000. Again, that's $22,000 more in taxes because you chose to save in this vehicle. Now, I hear you out there saying, but no, I'm going to be in a lower tax bracket when I retire. So let's do that. The withdrawal tax bracket, let's lower that to 25%. So you'll see, with the same 5% rate of return. So my account balance remains the same at $625,000. Now the good news is my share went up. So I now get to keep more of my own money. I get to keep $468,000. But I'm still going to have to give the government $156,000. Again, I postponed paying $108,000 so I could turn around and give them $156,000. I am paying more in taxes. Now, let's say that taxes are higher at withdrawal. When you retire, taxes will be at a higher rate. The balance remains the same. Your share goes down. The government's share goes up. You postponed paying $108,000, but now you get to give the government $218,000. Now, please understand me. I do not believe qualified plans are good or bad. They are just a financial vehicle to build wealth. My goal is to educate families on how qualified plans really work. You do not save taxes in a qualified plan. You only postpone taxes. My name is Monica Felton, and I teach families efficient financial strategies to create wealth so they can reach their goals sooner and with more certainty. Thank you so much for listening.